Rahul Singh, Head of Research at Standard Chartered Securities India, joins us right now on the show. Rahul, great having you. Thanks for joining in. Two spaces which are rupee sensitive too, Rahul. Pharma for one, and I know it's very stock specific there, but even other sectors like textiles, for example, have done really well in the last 1 month. And more reports that I see seem convinced about the export-oriented stories doing very well over the course of the next 12 months. Where do you stand here?
I broadly agree with that thesis, though in IT services we had been overweight and we had favored the sector over consumers, especially over the last 12 months, the entire 2013. We've actually cut our overweight position a little bit on IT services because the stocks have run up too hard. But I don't see from a 2 to 3 year perspective anything completely amiss in these sectors, both pharma and IT. Of course, we have to be stock specific also. So like I said, if you're looking at short term, we have to be stock specific. We have to look at the likes of Wipro or Tech Mahindra, although all the stocks have run up, but we have to incrementally focus on which stocks can outperform the sector rather than just taking a blind call on the sector. So it is going to become slightly more granular now within the sector than what has been in the last 6 to 9 months in my view. But we remain overweight on pharma as well. We don't have too much coverage on textiles, so can't comment on it.
And what about the rest of the market though? I mean, the overall market, start of this year and the market has been extremely sideways, the mood has been extremely tempered. What's the next big trigger which could give us some sort of direction?
Well, I think the big trigger has to be I think the opinion polls which might start trickling in Feb-March time frame. Because that's the broad direction which the market will look towards. The state elections, though good, though threw up market favorable results in a way, have the subsequent events after that have tempered that excitement because of obviously what happened in Delhi and therefore the kind of possibility of national elections being throwing up kind of a divided mandate has gone up. I won't say the probability has gone up too much, but definitely market does not like uncertainty. So even if the probability goes up a little bit, market does not like it, and what you're seeing now is probably a reflection of that. My own view is that once the opinion polls start coming in and once we get a clearer picture is when the broad market will get a direction, and that therefore remains pretty critical.
Rahul, just wondering, the reports over the last 1 month seem to be totally biased towards the mid-cap end of the market, and even the fund flow or the bulk data probably points towards that. How constructive are you on the broader end of the market, and where do you think most money could be made in the mid-cap end of the market?
Well, in mid-caps, if you look at the mid-cap index discount to Sensex or Nifty, it has now reached more of a median kind of a discount. So there has been a PE re-rating in the mid-cap index without really any earnings upside over the last 1 quarter or so. So the mid caps we like are basically Apollo Tyres, GE Shipping, Aditya Birla Nuvo. We like the mid cap IT space still. We recently upgraded eClerx. So those are the few names which we are very bullish on. Among the infra space, the only mid-cap stock we like is Adani Ports. And just moving away from the mid-cap, because some of the oil marketing companies are also now reduced to mid-cap. So we like HPCL purely from a valuation play. I think there is just too much pessimism, and as we get closer and closer to elections, and as there is more clarity on us getting a new government, even if it's not as strong as what we all hope for or wish for, a new government can always attack some of these pending reforms with much more vigor than what an old government can do in the last year of their tenure. So that's where we are in terms of the mid-cap spread and where we think the money can be made.
Fair call. Just one word on how are you approaching the metal space as well, because again, and the reason I'm asking this to you is because there's a clear dichotomy in way some of the stocks have behaved the last couple of months. We have a Tata Steel which has moved from 200 to 400, SSR Sterlite because of specific news has done very well, and on the other hand we have tons of names like Hindalco which barely have moved an inch. Forget the mid caps, of course. How do you play the commodities for the next 12 months?
We are negative on the entire pack. We were positive on Tata Steel and JSW. We recently, just this week, downgraded both the stocks.